General, yeah. So one of the reasons we look at speculative positions in futures is because generally those are, quote unquote weaker hands, or people who will get out of their positions very quickly if the market goes against them. So you can have a massive short covering rally, for example, in futures. But there's other things going on in the futures market right now that are much more technical. So there's people trade the cash treasury against the future, and when you do that, your risk is zero, right, or near zero. And the reason you do that is because there's oddities in the funding market and what's going on in the repo market and stuff like that. I won't bore you, but there's a book out there called The Bond Basis.
Deep in the weeds, dude.
Well, it is,
but
it's one of the reasons why you can't only look at like the derivative side of the equation in this case, because there is.
Don't worry, we're not.
Listen.
I would never give investment advice. And anytime I have, I've been wrong and people have lost money. And I'm sure you don't want to give it either. But isn't this a slam dunk time to buy U.S. Treasuries? I mean, price low, yield high, and like either way, you get the return or you get capital appreciation from here.
Yeah, so it really depends on what kind of investor and what time horizon you're talking about. So if you want to, certainly at 4.35, buying a 10-year and holding it for 10 years means you're going to make 4.35% a year, right? That's way better than what you've had the past decade, right? So for sure, there are opportunities there if you're a little bit risk averse.
And they can't go much higher, can they?
Well, they theoretically can. I mean, if we have let's have a situation. I was out in California visiting customers last week, and I talked to a whole bunch of investors. A dozen or so, large money managers. And there were one or two that are worried about a scenario where we do have a little bit of an economic slowdown going into 2024.
Were you talking to Jeff Sherman at TCW?
But then we see a reacceleration of inflation later in the year into 2025. And if we do get something like that, then there's the distinct possibility that you can wind up in another inflationary impulse getting 10-year yields at 5.5%. In fact, we put out a note today just looking at where 5-year Treasury notes could go in a situation where you do have that reacceleration, Fed hikes to 6%. Now, what's interesting is that in almost all of those scenarios, you continue to have a very inverted yield curve because the market's going to continually price for the Fed to at some point cut, even if it hikes more, right? And that's one of the interesting scenarios that we'll probably have over the next couple of years.
So why do you think the S&P 500 is trading about 1,000 points higher than it was last year when the 10-year peaked out? What's changed in the bond market to where maybe if you're looking at the equity side of things, it's more resilient?
That's a better question for Gina Martin Adams, our equity strategist, than me. But I would imagine valuation certainly part of it, and the fact that we haven't had a landing, right? The fact that profitability hasn't come down because businesses so far have been able to pass along some of the price increases. Now, will that continue? That's a different question. If you continue to have slower inflation and higher costs, then obviously profit margins have to suffer in that situation, and that's where you can wind up if risk assets swoon a little bit and you have the S&P 500 goes down 5% or something, then that's where you probably get 10-year yields headed back toward 4% in a hurry. And our forecast, by the way, just so you know, Matt, since you asked the question, we do have a forecast for the end of next year of 10-year yields at about 100 basis points lower than they are today at 3.32%.